Did you know that an expert believes that there is a very big risk if holding Tesla stock? While many are pretty optimistic about Tesla and its stock's future, others believe that Tesla's continuous growth will soon face a halt. You definitely would not want to miss this one. In mid-May, the world's largest hedge fund, led by billionaire Ray Dalio, parted ways with its stake in Tesla. The hedge fund sold all of the 25,488 shares that it held in the Elon Musk-led Tesla. Earlier regulatory reports by Bridgewater indicated the hedge fund owned 25,488 Tesla shares as of the end of last year. Raymond Thomas Dalio, most known as Ray Dalio, is an American billionaire investor and hedge fund manager who has served as co-chief investment officer of the world's largest hedge fund, Bridgewater Associates. Dalio was previously known as a Tesla bull, but is now exhibiting support for Chinese electric vehicle makers instead. On the first day of November, Dalio published an article titled, "The Changing World Order is Approaching Stage 6, the War Stage." Dalio believes that the U.S. is on the brink of civil and/or international war. If this happens, holding Tesla stock may prove to be a very huge risk. If a civil war takes place in the U.S., Tesla stocks may not be very badly affected. In terms of an international war, it is a whole different matter altogether. If an international war breaks out, there will definitely be tensions between countries, which will make it very difficult for foreign companies like Tesla, for example, to operate domestically. Note that Tesla has production plants in Berlin and Shanghai. If that happens, Tesla may have to pay a very high price if they want to continue operating within China, for example. This is probably why Dalio, a former Tesla investor, decided to shift focus to Chinese EV makers instead. Well, it does make sense to invest in those other companies and not so much into Tesla if the tensions are increasing and there's going to be a capital war, for example, which almost always comes before the actual war. Dalio also pointed out that there are now classic signs of being on the brink of military war, such as using economic warfare that is existentially threatening. For example, the recently passed U.S. bill that could cut off needed semiconductor chips to China and Russia, cutting off natural gas to Europe, are analogous to the U.S. cutting off oil to Japan in 1941, which led to the Japanese bombing of Pearl Harbor. There are also the classic big increases in military spending that typically come just before wars. Simply put, when a war occurs, whether a civil war or an international war, it does not look good in all aspects. And that includes Tesla, even if it can be considered a big company. On a different note, Tesla shares tumbled about 50% in mid-October from their all-time high, amid a broader sell-off in the U.S. stock market that has hit growth and technology companies especially hard. The plunge came amid a wider meltdown in the markets as the threat of an economic shutdown rattled investors already bracing for the impact of rising inflation and higher interest rates. Undeniably, Tesla's dilemmas are numerous. For one, vehicle delivery in the third quarter took a hit due to logistical troubles, and some analysts warned that the climbing prices of the company's cars may also weigh on demand at some point. Also, Tesla's Shanghai factory has faced disruptions due to COVID-19 lockdowns in the city. The company has also dealt with supply shortages and a surge in raw material costs, as has almost every other automaker around the globe. Moreover, Tesla CEO Elon Musk's highly public attempt to first buy Twitter, then to walk away from the deal and buy it again, has also been a drag on the stock due to concerns that the company's leader is spreading himself too thin between several challenging ventures. For these reasons alone, without the threat of a possible war, some experts advise against holding Tesla stock. According to Sean Ross at Investopedia, there are several big risks in investing in Tesla stock. First, Tesla cars are still too expensive. Even with generous government incentives, such as tax breaks for alternative technology, potential consumers of Tesla's Model S are still faced with a large price tag. Even Tesla's new lower-cost option, Model 3, is still out of reach for most drivers. The cars are not only expensive for consumers to purchase, but they're also costly for Tesla to make. Vertical Group analyst Gordon Johnson estimated that the company lost roughly $14,000 on each of the Model 3 vehicles it sold in 2018, although these figures may improve as the company scales up. Second, Tesla could run out of batteries. One of the early problems Tesla executives ran into was a lack of batteries to power their products. However, Tesla has several plans in place to address this specific problem. Third, increased electric vehicle competition. While Tesla is not the first company to create electric cars, it seems to be the most successful thus far. Two notable competitors, the Chevrolet Bolt and the Nissan Leaf, failed to gain early traction because of high retail prices and limited driving range. Moreover, other companies plan to enter the electric car market in the next few years, including Mercedes-Benz, Volkswagen, Subaru, Ford, and BMW. If this happens, then Tesla's market share may start to get crowded. Some other tech companies may also join the fray. Apple Inc. believes it can challenge Tesla in the transportation industry, and Google has also placed bets on the auto industry. Elon Musk, as Tesla's CEO, also appears to be a great risk, according to Ross. In an SEC filing, Tesla noted on Tesla's reliance on Elon Musk. Tesla is highly dependent on the services of Elon Musk, techno king of Tesla and our chief executive officer, the company said. As soon as the second week of November came into view, Tesla shares dropped below $200. Aside from Tesla already dealing with COVID-19 related issues at its most productive facility in Shanghai, China, other factors are weighing on the stock too. That has led to a decline in the shares, with the stock reaching its lowest level in 18 months. As of November 7th at 8:43 a.m., Tesla shares were down 5%. Although Tesla's China plant was recently upgraded to produce an annual capacity of about 1.1 million vehicles, Barron's reported that the facility shipped 71,704 electric vehicles in October, down from the record 83,135 delivered the previous month. China's strict COVID-19 policies, which have resulted in lockdowns throughout the region, have negatively affected productivity. That has also impacted consumer demand in China, and it might be partly why Tesla recently lowered prices for Chinese customers. However, another factor could be weighing on Tesla shares, which don't have to do with the business itself. Although Tesla CEO Elon Musk has now taken over Twitter, that might not be the biggest concern for Tesla investors. Musk used some debt to buy Twitter, and interest payments will need to come from either the business's cash flow or some other source. Several companies have announced a suspension of advertising on Twitter until the new direction of the social media site is more clear. That could mean lower cash flow, and Musk might need to service the debt interest payments from his own funds. The problem for Tesla shareholders is that Musk might have to sell more Tesla stock if he needs to raise short-term cash. That could be what is now impacting Tesla stock, or it could be other shareholders trying to game that potential. According to Global Data, a data analytics and consulting company headquartered in London, Tesla has moderate risk profile and is one of the top 50 companies based on its proprietary risk assessment of the vehicle manufacturing sector in the automotive industry. Country and industry risk pillars strengthened the overall risk score of the company. An established market position is a strength for the company, but low profitability and a high proportion of debt could be causes of concern. Overall, there are several huge risks in investing in Tesla stock. Of course, investing in general is a risky business. Everything that offers a very high reward comes with certain risks. With regards to the EV stocks falling to below $200, currently sitting at $197.08 per share, shouldn't be a concern for long-term investors. In fact, for those wanting to hold Tesla stock for years, this could be a good chance to start a position at a better price. In terms of a possible war, whether civil or international, well, the risk is for investors to take. Whether they should hold their stocks or sell it would be their decision alone. Subscribe to this channel for a very big chance to be updated on more Tesla stock content.